Hey Doc, Sean Duncan with SMD Consulting and Accounting. Today, S-Corps. But first, let's knock out this disclaimer. Okay, disclaimer's out of the way, lawyers are happy, let's get to helping you out with some stuff. The S corporation is a very specific type of corporation. Technically, all S corporations started as C corporations and they just had to convert to the S small corporation. Bunch of rules on what does it mean and how it works. Less than 100 owners, you must be a US citizen or permanent resident, all kinds of stuff. Not worried about the technicalities. What I want to talk about is similar in the other ones we just did. What are the liabilities and what are the taxes, right? That's what we just want to cover so you can get an understanding or a flavor here. S corporations are exceptionally cool because they have a very clear set of rules related to liability and taxes. First and foremost, liability. The S corporation owner is a lot like the limited partner. They have limited liability to the extent of their investment. If you've got $300,000 into your practice and the thing goes under, yeah, you can lose your money. We kind of all know that, right? When you take a risk and something goes wrong, you might lose that thing. What you don't want to have them do is come after your house, your car, your cat, your dogs. You may not like the dogs, that's fine, you decide. But realistically, we don't want them punching through to your personal wealth, your personal assets. And hopefully we've already protected some of that stuff too. But how can we make sure that doesn't happen? S corporations by statute have limited liability. There's rules though. There's a very big concern about that to make sure that you're following that rule, which we'll touch on in a second. Second, though, is the taxes. The net income from your practice, not subject to the employment tax. Remember the thing we were talking about with the partnerships where general partners pay full self-employment tax, possibly as high as an additional 15.3%, and limited partners don't have to pay that? By statute, S-Corps don't have to do it as part of their net income. So when I said there's a very important rule, the single most important rule about S corporations that I need you to know about first is reasonable compensation. In order to enjoy the benefits of limited liability and the lower taxation, you must pay yourself a reasonable salary to be the officer of that company. Now, what's the definition of reasonable? Well, it ain't zero. That's the first rule, and keep that in mind because that's important. That's the trick everybody thinks they've outsmarted the IRS on. There are studies we do. We use tools and case law and reports to analyze what is a reasonable compensation. The reasonable compensation for a heart doc is not the same as a reasonable compensation for an OPED. It's not the same for a orthopedic surgeon. They're all different, and also it depends on your role in the business. If in your practice you see patients 75% of the time and run the operations 25, that is a different compensation level than 50-50. We do those analysis, and a lot of good CPAs do that analysis as well to understand what that number is. Why is it relevant? Because that reasonable compensation is a wage. You have to send yourself a W-2, which see, that doesn't tend to happen in sole proprietorships and partnerships. You're like, wait, I have to send myself a paycheck? Yeah, it's actually part of the rule. In that paycheck, there's employment taxes. See that 15.3% that you're avoiding from the net income, you do have to pay some, but see, there's a control. So if your practice makes $500,000 of net income that year, and we determine that your reasonable compensation is $200,000, $300 hits the bottom line. Simple math, right? What's critical is that $300,000 is not subject to that tax. But what if we can prove that your reasonable compensation should be $150 and not $200? Yeah, we just saved you that employment tax on the $50,000. This is where proactive strategy starts to really kick in. How do we set things up to minimize the tax that's coming later and still get to enjoy that benefit? Now, a whammy that comes with some S corporations is another rule in that all things must be proportionate. So if you and I are in practice together and you're the 60% owner and I'm the 40% owner, you have 60% of the net income that comes your way and you're subject to all the taxes and liabilities. And I get 40%. Makes sense, right? That's pretty common sense. But see, with partnerships, you don't have to stay proportionate. You can kind of get cute with those things. If we decide, you know what, I really need a lot of money, I got to pay off these student loans, these are killing me, and we kick out $100K so I can knock some of these things out, if you don't take your proportionate share, we have legally changed our ownership structure. So manage these things in exchange for these cool little benefits, have a few more rules. They're not a bad entity type. In fact, that's important to know. All the entities, there's not a good or bad. It's what fits you, your goals, your obligations, and everything else about what you're trying to do with that practice. So the S corporation, at its core, is a little more strict, but in exchange for the strict rules that go with it, you would come with it a lower audit risk. Hey, I didn't say that before, but yeah, slightly lower audit risk because of the rules. You have more rules to follow. They understand that you might not be as much of monkeying around with this. But no self-employment tax on the net income, and specifically documented limited liability. So when you're choosing entity types, this is one to definitely discuss. It doesn't fit everyone, particularly in practices that you do what you do, you eat what you kill, but definitely consider it because it's a very clean, structured organization. I hope that's helpful. If you've got questions or you want more details, please let me know. We're happy to do more videos on this stuff. Hey, Doc, thanks for coming.